Mutual funds. Contents. Mutual fund basics. How are mutual funds set up? Types of mutual fund schemes. Classification based on investment objectives. Investment plans or options available to investors. Benefits of mutual fund. Mutual fund myths. Now come to the chapter 1. Mutual fund basics. A mutual fund is a trust that collects money from investors who share a common financial goal and invest the proceeds in different assets classes as defined by the investment object. Simply put, mutual fund is a financial intermediary set up with an objective to professionally manage the money pooled from the investor at large. By pooling money together in a mutual fund, investors can enjoy economies of scale and can purchase stocks or bonds at a much lower trading cost compared to direct investing in capital markets. The other advantages are diversification, stock and bond selection by experts, low cost convenience, and flexibility. An investor in a mutual fund scheme receives units which are in accordance with the quantum of money invested by him. These units represent an investor's proportionate ownership into the assets of a scheme and his liability in case of loss to the mutual fund is limited to the extent of amount invested by him. The pooling of resources is the biggest strength for mutual funds. The relatively lower amounts required for investing into a mutual fund scheme enables small retail investors to enjoy the benefits of professional money management and lends access to different markets which they have otherwise may not be able to access. The investment experts who invest the pooled money on behalf of investors of the scheme are known as fund managers. These fund managers take the investment decisions pertaining to the selection of securities and the proportion of investments to be made into them. However, these decisions are governed by certain guidelines which are decided by the investment objectives, investment pattern of the scheme, and are subject to regulatory restrictions. It is this investment objective and investment pattern which also guides the investor in choosing the right fund for his investment purpose. Today, these are a variety of schemes offered by mutual funds in India which cater to different categories of investors to suit different financial objectives. Exactly, some schemes may provide capital protection for the risk averse investor, whereas some other schemes may provide for capital appreciation by investing a middle or small cap segment of the equity market for the more aggressive investor. The diversity in investment objectives and mandates has helped to classify and subclassify the schemes accordingly. The board classification can be done at the asset class levels. Thus, we have equity funds, bond funds, liquidity funds, balanced funds, gilt funds, etc. These can be further subclassified into different categories like mid-cap funds, small-cap funds, sector funds, index funds, etc. How are mutual funds set up? A mutual fund is set up in the form of trust which has sponsored trustees, assets management company AMC, and custodian. The trust is established by a sponsor or more than one sponsor who is like a promoter of a company and registered with Securities and Exchange Board of India (SEBI). The trustees of the mutual fund hold its property for the benefit of the unit holders. Asset management company AMC approved by SEBI manages the funds by making investments in various types of securities. Custodians, who is registered with SEBI, holds the securities of various schemes of the fund in its custody. The trustees are vested with the general power of superintendence and direction over the AMC. The monitor the performance and compliance of SEBI regulations by the mutual fund. SEBI regulations require that at least two-thirds of the directors of trustees company or board of trustees must be independent, that is, they should not be associated with the sponsors. Also, 50% of the directors of AMC must be independent. Third, types of mutual fund schemes. Mutual fund schemes can be classified into different categories and subcategories based on their investment objectives of their maturity periods. Mutual fund schemes can be classified into three categories based on their mutual maturity periods. Open-ended funds. An open-ended fund of scheme is one that is available for subscriptions and redemptions on a continuous basis. Investors can conveniently buy and sell units at net assets value NAV related prices, which are declared on a daily basis. Closed-ended funds. A closed-ended fund of or scheme has stipulated maturity period which can range from a few months to a few years, exactly 6 months, 5 years, or 7 years. That is, fund is open for subscription only during a specified period at the time of launch of the scheme, which is the new fund offer NFO. Investors can invest in the scheme at the time of the NFO, and thereafter they can buy or sell the units of the scheme on the stock exchange, where the units have to be mandatorily listed. Interval funds. These schemes are a cross between an open-ended and closed-ended structure. These schemes are open for both purchase and redemption during pre-specified intervals, viz. Monthly, quarterly, annually, etc. At the prevailing NAV, net asset value based prices, interval funds are very similar to closed-ended funds but differ on the following points. They are not required to be listed on the stock exchanges as they have an inbuilt redemption window. They can make fresh issue of units during the specified interval period at the prevailing NAV based prices. Maturity period is not defined. Exchange traded funds. Exchange traded funds or ETFs are essentially index funds that are listed and traded on exchanges like stocks. They enable investors to gain broad exposure to indices on stock markets in India and in some cases in other countries as well. These indices, if based on certain specific sectors, themes, would thus provide exposure to such sectors with relative ease on a real-time basis and at a lower cost than many other forms of investing. For example, there are ETFs, exchanges traded funds, that track S&P, CNX, Nifty, BSE Sensex, etc. Gold ETFs are mutual fund schemes where the underlying investment is in physical gold. Fund of funds. FOF, as the name suggests, are schemes which invest in other mutual fund schemes. The concept is popular in markets where there are number of mutual funds offering, and choosing a suitable scheme according to one's objective is tough. Just a mutual fund scheme invest in a portfolio of securities such as equity, debt, etc. The underlying investments for a FOF is the units of other mutual fund scheme, either from the same fund family or from other fund houses or from funds domiciled outside the home country, known as overseas feeder fund or funds explained in detail under section types of equity funds. Number 4. Classification based on investment objectives. Apart from the above classification, mutual fund schemes can also be classified based on their investment objectives. Equity funds, growth or equity oriented schemes are those schemes which predominantly invest in equity and equally equity related instruments